Welcome back to the deep dive. We've got your sources here, ready to unpack one of the really big names in crypto finance. Today we're diving into Aave. That's AAVE. It's foundational in decentralized finance, or DeFi. We're aiming to explain what it is, how it works, and why it's such a force, all in simple terms. You should walk away feeling totally up to speed.
And when you say force, that's really not an overstatement. Aave is consistently a major player, often commands something like 20%, sometimes even close to half of the entire DeFi lending space. Its peak total value locked, the TVL, hit figures like $41.1 billion. I mean, that's huge, comparable to a pretty large U.S. bank, actually.
Wow, okay. $41 billion definitely puts it in perspective. Right, let's do this the deep dive way. Start simple. We'll begin with a basic problem Aave set out to solve, then get into how it works, and finally cover the risks. Sound good?
Sounds perfect.
So let's rewind. Before Aave, why did we even need something like decentralized lending? What was actually broken with the old system?
Yeah, the core issue was fundamentally trust, or maybe the need for trust. In centralized finance, CeFi think platforms like Celsius or BlockFi, which, went bankrupt.
Yeah.
You had to hand over your crypto. You were trusting them to manage it, to keep it safe.
Right, you're giving them custody.
Exactly.
Yeah.
And that creates huge risks. Single points of failure, not much transparency, and the big one, custody risk. When those companies collapsed, people just lost their funds. No recourse.
Okay, so Aave's answer is being non-custodial. How does that work?
Precisely. Aave is what's called a non-custodial, decentralized liquidity protocol. You don't send your assets to Aave, the company. Instead, you interact directly with open-source smart contracts. Code, basically. Transparent code. Aave never holds your private keys.
So you keep control.
Always.
You always keep control. It cuts out that risky middleman entirely.
That distinction feels critical dealing with code versus a company. Now, our sources mentioned Aave didn't start this way. It began as ETHLend back in 2017, peer-to-peer.
That's right, ETHLend. The initial idea was peer-to-peer, or P2P. And why didn't that work out? It sounds intuitive, matching lenders and borrowers directly.
It sounds intuitive, but in practice, it was really inefficient. Imagine you wanted to borrow, say, $5,000 worth of ETH. You had to wait for someone else, an individual, to show up wanting to lend exactly $5,000 ETH on terms you both agreed on. It created this problem called liquidity fragmentation. Basically, the money was scattered everywhere in tiny bits, transactions were slow, finding a match was hard, and frankly, the user experience was just bad.
Okay, I can see how that wouldn't scale. So what was the big idea that fixed it? The pivot.
The pivot was to the pooled liquidity model. This is what became Aave. And Aave, by the way, is Finnish for ghost, kind of hinting at this transparent, almost invisible infrastructure running things. Think of it like this. Instead of matching individuals, they created a big, transparent community pot, like a self-running bank for each digital asset.
A community pot.
Yeah. So suppliers, the lenders, just deposit their funds, say USDC stablecoins, into this massive shared pool. Borrowers then don't need to find a specific lender. They just draw instantly from that big community pot as long as they put up enough collateral.
So pooling the money solved the matching problem. Everyone dips into the same source.
Exactly. It aggregated all that fragmented liquidity. That's what allowed it to scale and become what it is today. A place to supply assets and earn yield or borrow against collateral instantly.
Right, let's get into those mechanics. So I put my USDC into this pool. What do I get back? How do I know I'm earning interest? It's not like getting a bank statement, right?
No, it's much cooler, actually. This is where A tokens come in. Let's stick with your example. You supply $1,000 of USDC. The A's protocol instantly mints and sends $1,000 worth of AUSDC directly to your wallet. These A tokens are basically interest-bearing receipts.
Okay, receipts. So they represent my claim.
They represent your claim, pegged one-to-one to the value of the asset you supplied. But here's the neat part. The amount of AUSDC in your wallet starts increasing continuously in real time.
Wait, continuously? Like I can just watch the balance go up?
Pretty much, yeah. Every few seconds, it ticks up slightly, reflecting the interest you're earning. You don't have to claim it or wait for a monthly payout. It just compounds directly in your wallet.
That's very different. So my idle crypto isn't just sitting there, it's actively growing, and I hold the proof right in my wallet.
Exactly. They call it turning idle capital into a productive, liquid asset. And because these A tokens are tokens, you can even use them elsewhere in DeFi, maybe as collateral for something else, while they're still earning interest in the background.
Okay, that is a game changer. I can see why that's powerful. Now, who sets the interest rates if there's no bank committee?
It's all automated, algorithmic. The rates are determined purely by the utilization rate of each pool.
Utilization rate, meaning how much is being used?
Exactly. It's the ratio of how much money has been borrowed from the pool compared to the total amount supplied to the pool. Think of it like supply and demand. If lots of people are borrowing USDC and the pool is nearly empty, high utilization, the interest rate to borrow automatically goes way up.
Ah, to encourage more people to supply USDC because the return is better.
Precisely. And it also discourages more borrowing because it's expensive. Conversely, if the pool is full and hardly anyone is borrowing low utilization, the rates drop to encourage borrowing and lending activity. It's a self-balancing system.
Okay, that makes sense. A self-regulating economic engine. Now, we absolutely have to talk about flash loans. This sounds like science fiction. Zero collateral loans for potentially huge amounts. How is that even possible without just giving away money?
It sounds impossible, but it relies on a core property of blockchains, something called atomicity.
Atomicity?
Yeah, it means transactions are all or nothing. A flash loan lets you borrow millions, yes, with zero collateral up front. But the catch is, you must borrow the funds, do whatever you're going to do with them, and repay the loan, plus a small fee, all within the exact same single blockchain transaction.
The same transaction, so like in the same instant?
Essentially, yes. From the blockchain's perspective, it's one indivisible operation. Think of it like this. Either the entire sequence borrow, use, repay succeeds instantly, or the whole thing fails completely. If any part of it can't be completed, the initial borrowing step is automatically reversed, as if it never happened.
So money never actually leaves the pool unless the repayment is guaranteed within that same tiny time window?
Exactly. The protocol's funds are never truly at risk. It enables sophisticated traders to do things like arbitrage, buying low on one exchange and selling high on another simultaneously, or quickly swapping collateral types, all without needing their own huge stack of capital up front.
That's fascinating. Pure code enforcing the rules. But okay, flash loans sound pretty advanced. Let's bring it back to the average user. What are the really practical day-to-day benefits for someone just wanting to use Aave?
Sure. For most people, it boils down to a few key things. First, the simple yield generation we talked about, putting your crypto to work, earning interest passively.
Okay, earning interest. What else?
Second, efficient leveraging. Let's say you own Ethereum and you think the price will go up, but you need some cash now. Instead of selling your ETH and potentially creating a taxable event, you can deposit it as collateral on a map and borrow stablecoins like USDC against it.
And I still keep my original ETH.
You keep your ETH exposure. Of course, you need to maintain enough collateral that's over-collateralized, meaning your collateral is worth more than your loan. But it lets you access liquidity without selling your base asset. And third, there's Aave's own stablecoin, GHO. This was interesting. You can supply collateral, borrow GHO against it.
Right.
And you continue to earn yield on the collateral you supplied, even while you've borrowed GHO against it.
Wait, really? So I deposit ETH, earn interest on that ETH, and borrow GHO using that same ETH as collateral?
Yes. It's designed for maximum capital efficiency. You're making your assets work in multiple ways at the same time.
That sounds incredibly efficient. Almost too good to be true.
Well, it's a core feature, and they keep pushing efficiency. V3E mode, or efficiency mode, lets you borrow with very high leverage if your collateral and the asset you're borrowing are closely related, like two different stablecoins, or maybe ETH and staked ETH. Because their prices move together, the risk of getting liquidated is much lower.
We also saw notes about an upcoming Aave V4. Sounds like they're planning a big overhaul. Are they hitting limits?
In a way, yeah. It's a problem of success. Aave is deployed on like 14 or more different blockchains now. Ethereum, Polygon, Avalanche, Arbitrum.
So the liquidity, those community pots are scattered across all these different chains?
Exactly. That's liquidity fragmentation again, but at a larger scale. V4 is designed to fix this with a new hub-and-spoke architecture.
Hub and spoke, like
Yeah.
connecting all the branches back to a central point.
That's a great way to put it. The idea is to make liquidity flow much more easily between all the different IB deployments, making the whole system feel more like one giant unified pool, regardless of which chain you're using.
So better efficiency, smoother experience.
That's the goal. Plus, V4 is expected to introduce things like a reinvestment module. The idea is that any capital in the pools that isn't currently being borrowed could be automatically put to work in very low-risk yield strategies. Some estimates suggest this could boost the interest rates for suppliers by maybe 10–15%.
Okay, constant innovation. But now we have to talk about the other side, the risks. Dealing with billions means things can go wrong. What are the biggest worries?
Absolutely. Need to be balanced here. One major risk comes from Aave's strength. Its complexity. All these features, flash loans, GHO, E-mode, V4's new architecture, They make the code base really complex.
And complexity means more places for bugs.
It increases the potential smart contract risk, yes. The risk that there's a flaw in the code that could be exploited.
But don't they have audits? Bug bounties? I saw mention of top firms like Open Zeppelin, Trail of Bits.
They do. They have extensive audits, a big $1 million bug bounty program. These are essential defenses, and Aave takes security incredibly seriously. But no audit can guarantee perfection. In DeFi, smart contract risk is always a factor, especially with complex systems. Then there's Oracle risk. This is a big external dependency. Aave needs accurate, real-time price feeds to know the value of your collateral and your debt. It primarily relies on third-party oracles, mostly Chainlink.
So if the price feed is wrong or manipulated?
It could be catastrophic. Wrong prices could lead to unfair liquidations, where people's collateral is sold when it shouldn't be, or it could cause the protocol itself to lose money if collateral is suddenly worth less than thought.
So it's heavily reliant on Chainlink being accurate and secure.
Very reliant. It's a critical piece of infrastructure. Beyond that, you have the obvious market volatility risk.
Right.
Crypto markets can crash hard and fast.
Right, like a sudden massive drop in ETH price.
Exactly. If prices fall too quickly, the system might not be able to liquidate underwater positions fast enough to cover the debt. This could lead to bad debt for the protocol. Aave has a safety module to handle this. Aave token holders can stake their tokens in this module, acting as insurance. If there's a shortfall, some of those staked Aave tokens can be sold off to make the protocol whole. It's the backstop.
So the token holders are the insurers of last resort.
Correct. And finally, you can't ignore regulatory uncertainty. Aave operates globally, but the rules for DeFi are still being written, and they vary wildly. Regulators, like the SEC in the US, could potentially step in and say the Aave token is a security or challenge certain mechanisms. That's a major unknown.
And what about the GHO stablecoin? Has it always held its peg?
GHO has had some challenges. There have been periods, especially during market stress, where it has traded slightly below its intended $1 peg. Managing its stability is an ongoing task for Aave governance.
You know, this is a great point to quickly pause and remind our listeners of something.
That's right. If you're enjoying how we break down these complex projects into simple pieces and want more reviews just like this, make sure you subscribe to our channel, CryptoBox. We do all the complex research, so you don't have to. Okay, let's bring it all together. Time for the wrap-up. Can you give us that concise 1 or 2 sentence summary of Aave?
Sure. Aave is the dominant, innovative, decentralized liquidity protocol, allowing users to securely lend and borrow digital assets via automated smart contracts, known for pioneering features like flash loans and its native GHO stablecoin.
Perfect. And for you listening, the key things to remember: that crucial shift from peer-to-peer to the efficient pooled liquidity model. Tokens is your growing interest-bearing receipts, and the big goal of V4 to unify liquidity across chains.
And maybe one final thought to leave you with, connecting back to that massive scale we talked about, the billions in TVL. Aave isn't just staying in the crypto world, it's actively trying to build bridges to traditional finance.
Well, they have things like Aave, which is a version of Aave designed for institutions that need to comply with KYC regulations. Know your customer, anti-money laundering. And there's the Horizon initiative, looking at allowing traditional regulated assets like tokenized money market funds to be used as collateral within Aave.
So bringing Wall Street onto the blockchain, essentially.
That seems to be the ambition. The really big question for the next few years, maybe the next decade, is this: can Aave successfully convince institutional capital, the big money managers, that the speed, transparency, and efficiency of DeFi code can actually operate safely alongside, and maybe even within, the existing world of financial regulation?
That's a huge question, if they manage that.
If they manage that, the potential scale could dwarf what we've seen so far.
A fascinating challenge indeed. All right, that wraps up our deep dive into Aave. We hope this breakdown was helpful and leaves you feeling well informed. Thanks for joining us, and we'll see you next time on The Deep Dive.